So this is how does asset level lease accounting work? So before we get into some of the conversations relating to the need for asset level management and asset level accounting, we're going to provide a simple example of a scenario that we encountered with one of our clients when using Lease Accelerator, and an example that is also included in our white paper. I think if people can visualize this transaction and the related asset level accounting, it'll help as we move on to additional topics relating to challenges with contract level approach and the decisions, judgments, and events at the asset level that are sometimes required with current accounting, but will be a definite compliance requirement under the new standard. So this is an example of an equipment lease that has 3 assets, 3 computer servers. The 3 servers were procured on the same lease, so in the same lease contract, and provided internally to 3 different asset owners, an IT manager in infrastructure, 1 in engineering, and 1 in finance. So to keep it simple, let's say the accounting here follows the current U.S. GAAP, ASC 840, and the 3 servers are treated as capital leased assets, which would be very similar to a finance lease under ASC 842. So the concepts we're explaining here are not unique to any particular lease standard, but they're definitely more relevant to on-balance sheet leases, which is the direction, of course, that all leases are taking. So in this example, server number 1631 goes into a contractual quarterly renewal at end of term. Server 1632 goes into monthly evergreen payment as no decision's been made to return, renew, buy out that asset. And server 1633, there's a buyout at the end of term. So it sounds pretty simple until you get into some of the details. And so we can understand some of the numbers we're going to be seeing in subsequent slides, it's important to understand some of the details on these server transactions. Again, 1631 has a contractual renewal for 6 months, but instead of continuing on a monthly payment, it switched to 2 quarterly payments for those 6 months at $312 a quarter. And server 1632 simply continued on monthly evergreen. Its rental was $204.74, which is the same rental that was associated with the other 2 assets during the regular term. So you would expect to see 3 times that amount, or $614, throughout the life of the original term lease as the payment for the entire lease contract. And server 1633 was bought out at the end of the lease for $750, effective August 31st. So just try to remember some of these numbers as we move forward into the following slides. Okay, so let's look at the payment schedule for this lease contract. The top table in green starts out with the very last original lease term payment, which is the 3 servers at $204 per month for a total of $614. That is what they've been paying for 36 months. So we're just showing the last month here. But a lot happened at the end of the term. We had one asset that went into quarterly payments in advance, and another asset that was bought out. So what you'll see in the second month is the 1 quarterly payment for 3 months in advance, plus the regular monthly rental on server 1632. So that's where the 516.74 comes from. You just need to look at the second row and the blue table below to understand the second row and the green table above. And as we move on to the third month, you'll see a payment of only $204.74 relating to the 1 server in Evergreen. So there are no payments on the bought out asset, obviously, and there are no payments in the month on the server with quarterly payments. So that doesn't mean there's no expense treatment on the server with quarterly payments. It simply means there's no cash going out in that month on that server. So I won't go through each of the remaining payment rows, but you can get an idea just by looking at the asset level payment at the bottom in blue and what the individual rentals are for each server. Now, before I go to the next slide, this scenario is quite common today, but usually these are operating leases. So the accounting tends to be more straightforward, as operating leases tend to follow the procure to pay process, and the expense for the month will simply follow the amount invoiced or repeater payments. There's no concern with operating leases as to the amount of assets and liabilities you need to take off your books. So hopefully somebody here, would identify the quarterly payment in an operating lease and set up a deferred rent account for that one server. So we're going to get into some of the details later on as to the additional complexities that result when these assets move on to the balance sheet. But companies who may be capable of managing these types of transactions today with operating lease accounting will not be able to do this on any grand scale when they move on to the balance sheet. So obviously, all of the subledger entries for these 3 leased assets over their life would be quite detailed, a lot of columns and rows. What we tried to do here is pick out just a couple of months summary view, so you can see the type of asset level accounting that's required for each of these assets. You're not seeing the GL string or any other basic information for demonstration purposes, but do bear in mind that each of these rows and entries would be associated to a GL string that may have different components, such as different cost centers, different project codes, and they would likely share common components as well, within a single lease contract, such as legal entity, and we'll expand on that later. So if you look at the first section for server 1633 in the comments column, in the green, you'll see the accounting for the bought out server. You'll see the depreciation expense for that asset in the last month, the recording of the buyout for $750, and the reversal on your books of the balance and accumulated depreciation and the original present value capitalized for that server. So all of these entries, of course, need to occur or you have incorrect accounting. If you look at the second section in blue for server 1631, you'll see quarterly payments for $312, but you'll see we're only expensing in the month 1/3 of that amount to respect basic accrual accounting within both the old and new standard. And if you look at the last section for server 1632, that's simply a regular monthly expense on the server in Evergreen. Now, this is just one obviously very simple example of 3 servers. But what happens when you get into hundreds of assets or thousands of assets on a single lease schedule that have varying lease terms and assets that are not similar with different costs and rent amounts? Think of all the level of complexity that you can get into with regards to accounting. Are you able to drill down on a particular asset to see the asset and liability and income statement entries? Can you prove to your auditor by drilling down from the portfolio level to the lease contractor schedule level to the individual asset level to support your accounting entries? So this is a very simple example to explain with 3 assets, but you'll likely need to multiply this level of complexity many times over, depending on the nature and complexity and size of your leasing portfolio. So depending on how frequent it is that your assets have different end-of-term events occurring at different times, like Michael talked about, depending on how much variability exists with regards to the components in your GL string for an individual asset. Okay, so we're done with this example. Let's get a bit higher level now and talk about what some of the challenges would be if we did not have asset level accounting, asset level management, and we recorded the amounts at the lease contract level. When I say contract, I'm referring to a lease schedule within a master lease agreement, for those of you familiar with leasing. What if the only rent amount that we captured was $614 rent and the related costs and other lease terms at a schedule or contract level? Well, if there's no net book value at the asset level and no net book value at the liability level, then how do you determine what amount to take off the books in the event of a midterm event? Not an issue today with operating lease accounting. And with the new lease accounting standard, of course, a midterm event means an event before the end of the reasonable certainty holding period. It doesn't necessarily mean an event before the end of the lease term. And some lease accounting systems suggest that they do asset level accounting by providing reports that allocate the rent to individual assets based upon a prorated cost amount. So two issues with this. First of all, it's reporting, not accounting. But also, unless the assets are identical in nature, they will have different lease rate factors applied to the cost. So when the accounting is performed, the amounts recorded to each asset will be incorrect, and it'll lead to a lot of administrative difficulties at end of term and through the life of the lease. So let's just take the server example. We see this often, when you have a blended lease rate factor or a prorated rent based on cost applied to each asset, and the end of term is reached where certain assets are returned or expire in the case of maintenance and services. And you're left with some surviving assets that are reflecting a rent on your books, which is completely different from what you're being invoiced for. So, for example, maintenance and services have no residual, so the payment associated with those assets will be higher than the payment associated with hardware assets. So this is not just an accounting issue. It can also be an invoicing-related issue. And while I know the current focus is on compliance, it will also yield incorrect amounts for economic analysis and your ability to negotiate with lessors at the end of term. So how are you going to know the effective rate earned by your lessor on that server that you bought out if you're not capturing the true financial attributes associated with that specific server? How will you calculate the ROI that the lessor is earning on that server? These are very common occurrences that we see on a regular basis. And sometimes the lessor simply does not want to give you the information because they don't want to know, so they don't want you to know their pricing on different components of a lease contract. So then you'll have to insist upon getting it, getting that pricing from the lessor, or attempt to establish standalone fair market values as discussed in the standard. I'm going to be getting into details later on with regards to the third chevron there, where lessees will not be able to comply with the standard if they're unable to make judgments on residuals, reasonable certainty holding periods, and asset impairment, as well as other issues at the asset level as is required by the standard with many of these judgments. And the last chevron, we're not going to get into details today on tax implications, but suffice to say that it's often critical to capture detailed financial information at the asset level in order to support property tax, sales tax, income tax, deferred income tax calculations, etc. And this information, often resides only in one centralized database, which is the lease accounting subledger. So even if the actual tax calculations take place in tax systems, much of the information going into that calculation needs to come from the lease subledger at the asset level. Okay, decisions, judgments, and events. There we go. Just 1 minute, please. Okay, so the remaining areas that I'll be covering have to do with, again, decisions, judgments, and events surrounding asset level information. I'm starting to hear this being discussed more frequently as of late, as people are starting to understand the need for this information to comply with the new standard. But there seems to be too heavy an emphasis, from what I've observed at least, on getting this information up front for the transition, and very little discussion about how this information is maintained or kept current over the life of the lease. So, many companies are going to need to undergo significant business process transformation in order to ensure these decisions, judgments, and events stay current and are performed on a frequent enough basis to comply with the new standards. So, when booking a new lease, as an example, under the new lease accounting standards, lessees must report the present value of lease payments And these, what you're looking on screen here, these are some of the asset level attributes that impact the present value calculation in both amount and duration. So you may already be aware of these factors, but try to think about them in the context of asset level instead of contract level. Term, how long are you reasonably certain to lease specific assets? So under ASC 842, the recognized lease term includes the non-cancelable period plus any optional periods where it is reasonably certain the lessee will exercise the option to renew, or in other words, not terminate the lease. Purchase option, the exercise price of a purchase option if the exercise is reasonably assured. The residual, the contractually specified residual payment and the likely payment on the residual guarantee that you're reasonably certain to make. So the former impacts classification, while the latter impacts the amount that's present valued. Penalties, if the term is assumed not to be renewed or extended, a lease may be subject to termination penalties, which has to also be included in the PV calculation. Lease rate factors, as discussed, if the assets have different lease rate factors within the same lease, these differences need to be captured to calculate the true rental for each asset. Okay, so asset changes that occur throughout the life of the lease impact accounting. So as the header says, asset level management impacts accounting. So management of those changes at the asset level is critical for compliance. And without a process, without policies and procedures, hopefully all automated, to keep the data current, the lease management system will eventually become unreliable. So for example, some people will place less importance on capturing non-financial attributes such as asset owner, who would be responsible for the GL string components of individual assets, or the asset user who would be responsible for attesting to the physical location of the asset. These are just people. They don't impact debits and credits. Well, wrong. Maintaining accurate physical and logical asset attributes do in fact impact accounting, debits and credits for leasing. So I'm sure this resonates very well with people who have experience managing purchase asset portfolios. If you don't know who to reach out for verification of the accuracy of those attributes, then how do you ensure proper accounting? If you have thousands of assets and you don't have an automated notification process or an automated attestation process, how are you capturing all of the important asset details? If you are capturing some of the important information in other systems, such as an IT asset management system, are you ensuring sufficient integration to transfer that information between systems? So, for example, ITAMs, or IT asset management systems, typically capture physical location, but they have no financial information. So how do you make sure that the information is captured once and only once and transferred to the appropriate systems? So I use the example with the asset owner, asset user, but the same concept applies to all other asset changes that can occur. How do you manage this data? How do you keep it current? And how important is it to you? If you have cost center errors, but if those errors have no impact on a roll-up level to your financial statements, and you're still in compliance with the new standard, and you want to perform your cost center allocations at a higher level, then that's your prerogative. But is it the most cost-efficient path to perform monthly allocations? What is the inherent risk of manual errors in this process? How is your existing process going to change as a result of the new standard? And the significant increase in the number of on-balance sheet leases. And what about all your other asset level attributes where month-end allocation is just not possible? Okay, so I've already discussed the need for maintaining accurate asset information. But how do you achieve a centralized database with centralized controls and policies where the updates to the data are done on a decentralized basis? So that's the challenge. So the next two slides give a high level of the participant types or the various stakeholders that may have knowledge of certain asset level information. There's many other stakeholders not listed here, including lessors who often have a significant amount of asset level information in downloadable electronic structured format. But once the data is loaded, if you are so lucky, these participants are frequently involved in adding to the database because you're only going to get a portion from the lessor, and maintaining the accuracy. So you can also reach out to your lessor, on a periodic basis to confirm details of all active lease assets. And this, in my experience, happens infrequently in practice. Too often we just see asset details for new equipment leases, procured in the first period. So the first slide is more focused on the traditional attestation of equipment lease assets. What are the end of term intentions? What is the location of the equipment? Confirm the accuracy of the existing cost centers. Identify any guaranteed residuals. For cost centers, do you allocate a single asset to multiple cost centers? Does your leasing subledger enable you to account for those multiple allocations? So in setting up a policy, you need to know when to ask, quarterly, semi-annually, monthly, who to ask. I gave an example with the asset owner, asset user. How many assets are they going to verify? Which assets? Are we getting some of this information from other systems? Do we need integration? How frequently do we remind individuals if they don't respond, weekly, daily? So all of these questions should be addressed, and you should be creating configurable business rules within your leasing application. And it should be evident that these business rules are simply, you should be able to go into your leasing application, look in the settings within your application, and see these business rules. And you should have reporting that enables you to understand what information exists, what information has been requested, what information has changed. The next slide looks almost the same as the last one, but the focus here is more on judgments required under the new standard and the periodic evaluation of original judgments and the changes to those judgments. So this is more focused on the new standard, again, and the judgments that need to be made at lease inception and often throughout the life of the lease to ensure proper accounting under the new standards. And we're not going to get into the specific requirements of the standard as they vary between 842, IFRS 16, as well as under current standards. That's for your accountants to do. And the frequency, level of effort that goes into this really will vary from one company to another based on the relative materiality, the leasing standards that you're complying with. But these concepts that the standards are moving towards, that's what's important here. And you have to have the flexibility within your system to incorporate these business rules, however detailed they may be. So for example, who has knowledge at lease inception and throughout the life of the lease as to what the reasonably certainty holding period is? It might be a 36-month lease contract, but maybe the business user, is certain to hold those assets for 48 months based upon current conditions. The location changes that we've talked about earlier may impact compliance with the master lease agreement, where we need to notify the lessor of location changes, or it impacts taxes as discussed earlier, or even insurance, where insurance may change from one location to another. You can have different insurance policies applying to different assets on the same lease contract. Have any asset impairments taken place? That would be under the guidance under asset impairments, not the lease accounting standard, but it is asset impairment. It's not lease contract impairment. What is the likely residual value as opposed to the guaranteed residual value? The residual value needs to be reassessed on a periodic basis. Who has knowledge of this information? Are they set up as a participant within your application so they may receive automatic notification? How frequently do we send them a request? What do we do if they don't respond to the request? So I realize I'm asking, more questions and giving answers, but these are the considerations that you need to evaluate. And again, configure as business rules within your leasing app. And they need to apply at the asset level. So some of them may apply from a compliance perspective. Some may apply simply from an economic perspective to ensure you're realizing the economic benefits of leasing. You might be negotiating an 80% PV up front, but are you actually realizing that PV, or are you incurring a PV that's far in excess of the original equipment cost, in which case you want to reconsider leasing certain assets. But you can't make that determination unless you're calculating the PV on an asset-by-asset basis. So this is more than just debits and credits. We've already spoken about a lot of these types of asset level information and why we need them. You can see most of them summarized on this slide. It's important to understand when we're talking about asset level information, what is it important for, and if it impacts our accounting or not. So some of the items are required for accounting compliance purposes. Some have more to do with management accounting. Some are strictly to help drive savings. So I won't read all of them, but I do want a few more minutes to address a few more items before I wrap it up and send it over to Michael. Non-lease components, deferred income taxes, and modification. So we've got about 20 minutes to go. I think I can wrap this up in a few more minutes. Lease contracts may contain, sorry, next slide. Lease contracts may contain non-lease components that should be accounted for using other accounting models. So examples, common area maintenance or services such as security. Here we see maintenance and support on these servers. So distinguishing between lease and non-lease components is important because it's not always appropriate to record assets and liabilities associated with non-lease components. So in order to determine if a component is a lease or non-lease component, you need to understand the new definition of a lease under the standard and apply it. Is it integral to the right to use the underlying assets? So you'll need to communicate with your accountants to understand how it's applied. Educating you on the standard is not the purpose of this webinar, but you might want to set up a policy in your leasing systems that identifies certain asset categories as lease components by default, and other asset categories as non-lease components to ease the implementation. And your lease accounting system, it needs to be able to account for each. It needs to be able to account for lease components. It needs to be able to account for non-lease components under all the standards. And there's also a practical expedient for lessees under the new standards. So a lessee may elect an accounting policy by asset class, so this is asset class, not an individual asset, to include both the lease and non-lease component as a single component and account for it as a lease. So basically treating non-lease components as lease components to reduce the administrative complexity. And so making this selection relieves the lessee of the obligation to perform a pricing allocation, although it will increase the total lease liability. You got to record in your balance sheet. And by the way, this expedient is not available to lessors, so lessors should be able to get you that data. Again, you might want to set up a policy in your leasing system that identifies certain asset categories for which this election applies to be treated by default as a lease component. So if maintenance is always an insignificant portion of your lease contract, and you take the election, you can by default always consider it to be a lease component, and you don't have to go through the segregation process or look at the definition of lease every time you book a deal. Tax timing differences, the single model applied by IFRS 16 is going to result in a significant increase in the number of timing differences at the asset level for companies reporting under international standards. So these differences need to be tracked for deferred income tax purposes, and they're critical in supporting deferred income tax entries with asset level reporting on accounting depreciation. Lessees may want to incorporate their accounting policy for depreciation of assets into the company's lease accounting software so that the appropriate depreciation methodology is applied to individual asset categories, and can be viewed in their software. So for example, you can have assets on the same lease contract that are depreciated over different terms following your internal policy. So for example, network equipment 60 months, computer service 48 months, and that's particularly relevant for leases with automatic transfer of ownership. So we have 15 minutes left. I'm going to skip the last slide. It gets into modifications and reassessments. Suffice to say, you need to track information to be able to make those determinations throughout the life.